Joining us first on CBC to make the case for being invested right now, John Duffy is vice chairman of JP Morgan's private bank, the world's largest private bank. They have nearly $500 billion in assets right now, and many of your clients are on that Forbes billionaire list right now, and you're telling them, be in the market, right?
We are, Bill. You know, even too much cash, a good thing, can work against you.
Do you blame them, though, for having that? I mean, you make that case that you would have missed some good up days in this market this year, primarily. You'd lost 12%, but you would have gained 12% if you were in the market. We had some big down days as well lately.
We have, and that's why this is really a risk management conversation. For investors with conventional portfolios, stocks, bonds, cash, they're really limited in their risk management choices between toggling back and forth between those three asset classes. That puts an unfortunate dependency on market timing for their portfolio outcomes. So since 1980, the S&P's returned 9.3%. If you miss the best 20 days, that's 5.7%. The best 30 days, that's 4.4%. Not the kind of returns that investors would associate with equities.
Wow, that's a big miss. I love the word toggle, because I think a lot of people do that, a few percentage points here to go to stocks and then over to bonds and back and forth, and they're often doing it at exactly the wrong times.
Very tough, very tough. Even professionals like ourselves, we don't want to be market timing dependent in our strategies.
But you talk about the asset classes that we all think of traditionally. I mean, stocks, bonds, cash, those. Where else do you go then? What do you broaden out to?
Great point. At the JP Morgan Private Bank, we put to work the risk management benefits of alternative asset class investing. Hedge funds, private equity, venture real estate, hard assets.
Pretty risky, though.
No, that's where we would disagree. What we're looking to deliver to investors is equity-like returns with fixed income-like volatility.
You recommend, if you're going to have a balanced risk portfolio, you say 40% equities, 35% cash and fixed income, and 25% alternative assets. Whenever people put up the ideal portfolio, they always caveat it with, it all depends on your risk tolerance, etc.
Right.
Do you think this is good for the general person?
So that's a balanced risk portfolio, right? That kind of sits in between capital preservation and growth. So is it ideal? It fits most of our clients, and I would say for the investor public, that's probably where many people fall out.
Does it shift as you get older?
It shifts
Doesn't sound like it.
And it shifts towards typically a higher component of fixed income. People are looking to replace their salaries, their bonus, augment their pensions. But what we love about the alternative asset class investing, you're right, Bill. Normally people think hedge funds more risk. You think exactly the opposite.
Actually, I was thinking real estate more risk. I mean, hedge funds, that's one thing. They hedge theoretically, but real estate's been very tough and no sign of a bottom yet.
True, but think about commercial real estate, right?
Give you that.
Think about global infrastructure plays. Think about real estate in other countries, be that India, China, the developing world. Clients, investors get the benefit of that at JP Morgan.
And hedge funds and alternative asset classes can get to those in a way that the average person can't just do through purchasing a stock.
Absolutely. Think about dislocation as creating opportunity. And these managers are some of the best managers at taking advantage of dislocation, be it in the leveraged loan marketplace, be it in the distressed space, topics that we talk about every day these days. We see value there.
So to quote Dan Rather, courage. Have the courage to get back in those markets again.
But okay.
I'll tell you about that later. John, nice to see you. Thanks for joining us today.
Good to be here.